no, welcome to this week's product walkthrough and Q&A session. My name is Dan. I'm a senior customer success specialist here at Snap. And today we're going to be going over our recommendations feature. Um, Now, in regards to any questions that you may have, um, please feel free to enter them in the Q&A box within your Zoom. If I don't get to your questions by the end of the session, just be assured that I will follow up with you by the end of today. So going back to our recommendations, in regards to questions, it does help answer some client questions like, when can I retire? Can I retire early? Am I saving enough? How much can I spend in retirement? So again, that's when our recommendations really come into play and help you out in your planning. Before I get into uh, our sample client, I do just want to highlight our help center, which can be found when you log into your Snap profile. At the top right is the Help Center. And this is a great resource for anything Snap. So you can search for something specific that you're looking for to model. There are different categories here that you can pick, and there's great step-by-step walkthroughs in there, videos, articles. So definitely take advantage of that. In the event that you're not able to find what you're looking for, that's when I would highly recommend that you get in touch with us here at the customer success team. We're here Monday to Friday, 9 to 6 Eastern Standard Time. So you can call us or you can shoot us a quick message with your inquiry. We try to grab everything within 2 hours and follow up with you. So if we don't pick up, please leave a voicemail. We will definitely follow up with you. Okay, so I'm going to hop back into my Snap. So I'm in my client list. I currently have all my clients hidden. So you can show all your clients by clicking the 3 lines at the top there, or hide all clients. For now, I am just going to search by last name here. So here we have our sample client, James Smith. I'm going to hop into scenario setup and kind of go over the assumptions quickly that we've made in this sample case. You can do that by clicking on the gear icon to go to scenario setup. You can also click on the second icon here to go to the planning pages. And finally, the client reports would be your third option. Okay, so just the basic information here: name, date of birth, province of residence. Under the general tab, we have them desiring to retire at age 65. We'll run that plan until age 100. And I've used our default assumptions for inflation as well as rates of return, which are based on FP Canada's recommendations. Now, the base expenses, James wants to spend $54,000 in retirement. He has no other additional expenses. And under incomes, we have his employment income of $100,000 running till age 64, the year before retirement. Under the assets tab, I've included his RSP, TFSA, and investments, as well as his house. And then he also has a small mortgage attached to that house. In regards to government benefits, we're going to assume that he's going to take them at age 65 for both CPP and OAS, and we've assumed 100% of the maximum for each of those benefits. Now, he has no insurance or RESPs, so I'm going to hop over now to our planning pages. Okay, so a few things to highlight on our planning pages before we get to the recommendations. You can see here we have the retirement age of 65 highlighted in bold. We have our CFM start age starting at that same year with that 54,000 in today's dollars of base expenses. So in 2031, he would be spending 61,171. What you're going to notice is the grayed out expenses here prior to retirement. So what is happening is we're considering the income of 100,000 less his CPP and EI deductions, less his taxes payable, less the contributions that I've included myself which is just indicated in yellow here for both RSP and TFSA. And finally, the mortgage payment of $7,200. So after all that's been considered, what's left over at the end of the year would be $54,532 for in the year of 2025, and that's assumed to be spent on the client's lifestyle. Okay, so I'm going to hop up now into our recommendations. So the first thing that you're going to see here is the retirement goal. So that's considering the retirement age, the desired level of spending, and whether that is going to be overfunded, underfunded, or funded. So in this example, it is overfunded by 118%. How we arrive at this figure, whether it's the percentage or overfunded, is in the last year of the projection, we are considering any cash balance plus any financial assets less any debts. If that number is above zero, it's going to be an overfunded plan. If it's below zero, it's going to be an underfunded plan. Now, we have the different recommendations here that can get us to a 100% funded plan. So starting with the retirement age. So what this will do is determine when's the earliest the client can retire. So in an overfunded position, it's going to recommend that the client retire earlier. And it will also adjust, if you apply and run the recommendation, it will also adjust the base expense assumption, any contributions, employment income, and overrides. There are additional adjustments that you can apply if you apply and run it. So the first four here that you see are going to be selected by default. But if you wanted to bring in CPP earlier in this example, based on the recommendation or OAS, or if the client had pension income or RIF and LIF withdrawals, you do have the option to select those, and the income will be brought in sooner. Once you make your selections and update, these will be saved for future recommendations when you run them. So you can come back in here and change those options as well. So I'm just going to leave it at our defaults for now. I'm going to go back to our planning pages, back to our recommendations. And again, this is an overfunded plan. So when I calculate this, I'm assuming SNAP is going to determine that the client can retire earlier. So I'm going to calculate that. And here's the answer. So 63. So he can retire 2 years earlier than the current plan. So I can leave that as is. I don't need to apply and run it. It hasn't been applied to the plan until you click on apply and run. So that might just be a conversation piece you want to bring with you when you present the plan. In this case, I will apply and run it, but before doing so, I'm going to make a copy of this scenario before applying and running it. I always recommend with any of these before applying and running that you do make a copy so you don't lose the original scenario that you've built. So I've made a copy, I will apply and run. It will now bring you into the new scenario. So in brackets, you can see retirement age recommendation was used. And now his retirement goal has been brought forward or back, I guess, to age 63 with the CFM start age, his desired 54,000 in expenses. You can see my overrides have been removed for those contributions for those additional 2 years. And now the plan is going to be funded. There's no deficit in the plan for retiring earlier. So that all looks good. So I'm going to just flip over to the opposite scenario. So I'm going to go back into my original scenario. And I'm just going to make a copy of this plan. So you can make a copy also by going to those 3 lines and copying the scenario. And I just want to illustrate if the client was in a shortfall or underfunded position. So I'm going to update his expenses right here on the planning pages. I'll copy that down. And I'm just going to run the scenario. And now we can see with that level of 65,000, he eventually does run into a shortfall position indicated by the red. I'm going to go back to recommendations. And I'm going to recalculate this. So we can see now the plan is underfunded. So let's calculate that. So the answer now is 67. So from our original plan of 65, he would have to work an additional 2 years. So if I apply and run that, and I've already made a copy, so I didn't select to create a new copy. So we can now see the retirement age has been moved to 67. We have the 65,000 in base expenses kicking in. We've left the CFM start age at 65. And if we move over, we can see that he would actually need to save some additional monies for those additional 2 years in order to avoid a shortfall in the plan. Why the RSP is getting the first contribution, the TFSA isn't, and the non-reg is based on the CFM order of contributions that you've selected. So you can see that order. If you come up to our gear icon under financial assets, we can show the CFM order column for this scenario. Two new columns will appear, the CFM order for contributions and withdrawals. And you can see here, we have our default order. So RSPs, tax-free, and then non-reg. So Snap, if there is the surplus cash or if cash needs to be saved, starting with the CFM age, it will do it in this order. The order can be changed. So for example, you can change it in any given year. You can come here and select a new order and copy it down for the life of the plan. So for example, run it to age 100, and you can do the same thing for withdrawals as well. So if you wanted to switch the order of withdrawals when cash was required to come out of the portfolio, you can do so here. So that's why we're seeing the RSP being maxed. So I'm just going to hover over the RSP so we can see the contribution room in the year 2032. If we move down to, my mouse is being a little silly. There we go. We can see the contribution room here as well. And then once that's maxed out, we can now see the TFSA contributions occurring as well. So we've postponed retirement. Again, with that level of spending, there is no shortfall in the plan. And that is the retirement age recommendation. So I'm going to hop over again back into our original sample scenario, and I'm going to talk about the sustainable spending recommendation. So I'm going to go back into recommendations and this is sustainable spending. So what this is it's going to find the maximum sustainable level of consistent spending from the CFM start age. So at this case, at age 65 when he retires for the life of the plan. So if I calculate this, and because it's overfunded, it's going to increase the base expense assumption. So I'm going to calculate that. And here's our answer. So he could spend 60,564, which is around 6,600 more than our current plan. So if I apply and run that after making a copy first, it will bring us into our new scenario and it will apply that recommendation. And you can see it goes for the life of the plan. There is no deficit in the plan. All financial assets are basically brought down to zero. The home or the real estate is left aside from the calculation, so it's never factored in. It won't sell the home in that calculation. It will only consider the financial assets and draw down all financial assets to zero. So the other thing with sustainable spending is you don't need to run it from the retirement age or the CFM start age. You can do it in future years. So in this example, if James wanted to spend an increased amount at the beginning of retirement, so let's assume 70,000, and we'll do that for the first 10 years. So I'm going to run that down to age 74. I'm going to run that plan. So you can see here, the 70,000 going for the first 10 years. Our original sustainable spending still sticks, but eventually we're going to run into that shortfall with that increase spending at the beginning of retirement. So if we go back into our recommendations, the age is highlighted in blue, just indicating it can be updated. So if I click on that, and I now update it to age 75 after the 10 years of 70,000, hit save, and then recalculate. And now provides me with a new spend goal from age 75 onward in the plan. So if I apply and run that, we have our 70,000 and then the new sustainable spending number gets us to the end of the plan without any deficits. Again, all financial assets are basically drawn down to zero, and our goal is 100% funded. Okay, so I'm going to go back into our sample scenario here, and I'm just going to touch on the available savings or required savings recommendation. So because the goal is overfunded, it's available savings. So when we hit calculate on this, what it's going to determine is what can be drawn out of the portfolio in the years leading up to retirement and still have the plan 100% funded. So I'm going to calculate that. And here's our answer. So there are four numbers here. The first one would be net of tax. So in this case, because we're withdrawing, it's the average annual withdrawal after tax. So showing the client what they could take out of the portfolio, again, each year leading up to retirement. The second number here is a gross figure. So again, the average annual withdrawals before tax, before any tax adjustments are applied. The last two numbers here are the difference between what I've indicated the client is contributing. So going back to those RSP and TFSA contributions and what is coming out of the portfolio here on an after-tax basis. And then the very same thing just on a gross basis. And you can see the question marks here provide you with a breakdown of exactly what these figures represent. So again, I'm going to copy this and I'm going to apply and run that. So now we can see on the non-reg portfolio, those withdrawals coming out. And the goal is 100% funded. There is no shortfall. If we look at this, it should say 100%. Yep. Now, the reason why it's just coming out of the non-reg portfolio is, again, because I have my overrides on here, Snap will not override what you've done on the planning pages. So in the event that these were cleared out, it would factor in withdrawals from each of these portfolios. Again, going back to our CFM order. So in this case, it would still stick, but if you had the withdrawals reversed, let's say, it would draw from the RSP first and then tax-free and then non-reg. So again, it's working around the CFM order. But again, because this is overridden, it's going to be pulling from solely from the non-reg. And then again, on the opposite side, if the plan was underfunded, so I'm just going to make a copy. I'll go back in and enter our increased expenses of 65,000. I'll copy that down. We run into that shortfall yet again. I'll go back up to my recommendations and hit calculate. So this is going to tell us the required savings. What can the client contribute on an annual basis leading up to retirement in order to meet this increased expense goal? And the answer here is 22,053. Again, going back to my overrides on the RSP and TFSA, this is only being directed to the non-reg, which is why these numbers are the same. So if I apply and run that, we can now see the contributions going in leading up to retirement. And again, based on this new level of spending, that gets us down to basically all assets depleted, and the goal being 100% funded. So that's required savings. Last but not least will be the lump sum savings. So I'm just going to go back into recommendations. So the lump sum savings will tell you what the client would need to either withdraw from the portfolio in an overfunded position or what they would need to contribute to the portfolio in the first year of the plan. So because we are overfunded, there will be a withdrawal. So I'm just going to calculate that. And we can see here, he can draw 156,715 from the portfolio and still be able to reach the expense goal of 54,000 through the life of the plan. So I've made a copy. I'm going to apply and run that. And here you can see the 156 coming out in the first year of the plan. And if we scroll down, no shortage, no shortfall, and the goal would be, again, 100% funded. I'm going to hop back into our original plan and just demonstrate if it were in a shortfall. So I'm going to copy. I'm in my new copy. I'll do that increased expenses. I'll run the scenario. We're in that shortfall yet again. So back up to recommendations, and now I'll calculate the required lump sum. So the answer is they would need to contribute in the first year of the plan 121,000 to the portfolio in order to fund their increased expenses of 65,000. So if I apply and run that, we can now scroll to the top and see that 120,803 being contributed. The plan is fully funded. The only thing I'm going to point out as a word of caution for both the annual required savings and lump sum, if we go over to our expenses, you're going to see negative 66,000 in this case. So what that recommendation is calculating is based on how much does the client need to save to spend 65,000 in this example through the life of the plan. So it may overstate what the client actually can contribute based on what's coming in. In this case, this isn't very realistic. The client obviously needs to live off something for lifestyle. So just pay attention to the expenses prior to retirement when running either the required savings or required lump sum. So that was relatively quick, but a lot of information thrown at you. That's what I wanted to cover today. If you did have any questions, which I'm trying to see if I have any, I don't see any, but I'll take another look after the call. I will definitely follow up if there are any questions by the end of today. But yeah, again, that's what I wanted to cover. One last thing, again, is our help center. Please definitely use that to your as a resource. It's great. You can find a lot of great information in there, videos, step-by-step guides. In the event you can't find anything, again, I can't recommend enough that you give us a call or send us an email. And again, we try to get back to everyone within that 2-hour window. So yeah, that's it. I'll let you get back to your day. I appreciate you joining, and I hope to see you at one of our next sessions. Thanks, everyone. Take care.